Imagine this. You're scrolling Zillow late at night, coffee in hand, picturing that perfect house. Big backyard, updated kitchen, maybe a home office that isn't also your closet. You type in your budget, and there it is. A $700,000 listing that somehow feels doable. Then reality creeps in. Wait, can I actually afford this monthly payment? That was me a few years ago. And if you're watching this, it's probably you right now.
My name's Alex, and I spend way too much time thinking about mortgages and home buying in this economy. If you're staring down a $500,000 or $700,000 house and feeling overwhelmed by rates, payments, and all the hidden costs, you're in the right place. Stick around, because by the end of this video, you'll know exactly what you can afford and how to avoid mortgage regret. The biggest mortgage lie. Let's bust the biggest lie first. Most people think, if I can afford the down payment, the rest will work itself out. That's like saying, if I can afford the plane ticket, the vacation is free. Mortgages aren't just the price of the house. They're interest, taxes, insurance, maintenance, and fees every single month for decades. And in 2026, even if rates dip, affordability is still tight. What a $700,000 house really costs. Let's talk real numbers. A $700,000 mortgage at around 6.5% over 30 years puts your principal and interest at roughly $4,400 a month. Now add property taxes, about $700 a month, insurance, $150 to $300, PMI if you're under 20% down, and HOA fees if applicable. Suddenly, that $700,000 house costs $5,300 to $5,600 every month. And that's before repairs, before furniture, before life happens. Pause on that number. $500,000 versus $700,000. Now compare that to $500,000. At similar rates, you're looking at roughly $3,800 to $4,000 all in. That $200,000 difference in price can mean $1,300 plus every month. That's the difference between breathing room and constant stress. Why rates dropping won't save you. A lot of people are saying, I'll just wait for rates to drop. Here's the problem. When rates drop, more buyers jump in, prices tend to rise, and competition heats up. Lower rates don't magically make a bad budget affordable. They just change who you're competing against. The math that actually matters. You don't need formulas, you need clarity. Ask yourself this: what's my monthly payment? What's my income buffer? What's my lifestyle tolerance? A 15-year mortgage saves massive interest, but the payment shock is real. A 30-year gives flexibility, but costs more long-term. Neither is wrong. What's wrong is choosing blindly.
The psychology behind overbuying. Here's why smart people still overbuy. Anchoring bias. You anchor to the home price or Zillow estimate, not the lifetime cost. Optimism bias. I'll earn more later. And FOMO. What if I never get another chance? Your brain is wired to downplay future pain. That's how $4,500 a month feels abstract until it hits your bank account.
How much you really need to earn. Let's talk income. Using conservative rules, housing shouldn't exceed about 28% of gross income. That means a $500,000 home often needs $150,000 plus household income. A $700,000 home can need $220,000 plus. Only about 1 in 5 households hit that comfortably. Lenders may approve you anyway. Approval is not affordability. If you don't have 20% down, no 20% down, you're not doomed. FHA loans, VA loans, low down payment options all exist. Just understand the trade-off: higher monthly payments, PMI sticking around, and less margin for error. Lower entry cost, higher monthly risk. Real story. A friend of mine, Mike, made about $120K. He bought a $500,000 fixer-upper thinking his payment would be $3,200. After taxes and insurance, closer to $3,600. 6 months in, he was stressed non-stop. He survived because he refinanced later, but the lesson stuck. Hope is not a strategy, it's math. 6 smart buyers make. Here's what prepared buyers do. Calculate DTI honestly. Clean up credit. Build a real down payment plan.
Get pre-approved early. Budget maintenance yearly. Choose loan terms intentionally. None of this is exciting. All of it works. Homes as investments. Yes, homes appreciate, but appreciation doesn't erase interest, taxes, insurance, maintenance. Homes build wealth slowly. They destroy it quickly if you overextend.
The 2026 advantage. Here's the good news. In 2026, prepared buyers win. Better terms, less panic, more leverage. Preparation is the real advantage. Buying a house shouldn't be a gamble. Master the math, understand the psychology, move with intention. If this helped, hit like, subscribe for more no BS money talk, and comment your biggest mortgage fear. I actually read them. Thanks for watching. I'll see you in the next one.